174. I can't believe that, but I guess the numbers went up when we started doing dailies. Anyway, hopefully this is a great Saturday for everybody. I was out walking and the weather was gorgeous. I have stats for us today, so let's get right into it. Oh, by the way, my host, Max, is taking his family on an outing this weekend. I think they got cabin fever and went to Brian Head. So I'm here by myself. We might have a guest that shows up, but we'll see. She may be having some technical difficulties. As you know, that happens. So let's get right into the stats on this Saturday morning. Hi, Karen. Good to see you. I feel like haven't seen you this week enough. Please stop by my office. We need to make a date. Let me get into the stats, everybody. So we finally, I think yesterday, we hit over 8,000 available homes, 8,119 homes. And we had 101 closings yesterday. That made it a good Friday for a lot of people. 101 closings means 202 agents got paid. So that's a wonderful thing. And 69 people went under contract. So that's really good too. And we just listed 189 homes yesterday. So our numbers are getting better and better as we go through this month of May. And year to date for Clark County, we have sold 12,956 homes, compare at the average price of $335,000. Now, compared to last year, year to date for 2019, we had sold 13,711 homes at an average price of $319,000. And if you can see the difference at 755 sales, and what's made the difference is this month. And like we said we said that yesterday or the day before, the thing that has made the difference, if you think about it, is the pandemic shutdown, lockdown, whatever you want to call it, came around May 17th. And as you know, it's about a 45 closing cycle sometimes. So that means this month is the month that's going to show the most hurt from the pandemic. And as we come out of this, I predict that these numbers will slowly get better and better, and we will still beat last year, this year. Houses are still getting listed. Houses are still getting under contract. We're still having closings, and we're down 755 homes year to date. And actually that is, let me think here, that is we're down about 6% for the year. So that's not bad. I just got a notice from my gal here that she can't get on. So let me see real quick. You may lose me for a second. I'll be right back. Let me see, Samir, why we can't get you on. Try that now, Samir. Try it again, Samir. I sent it again. Hopefully you can hear me. I have a guest and I'm so anxious to have her on. But things happen. Anyway, so getting back, I'm sorry, everybody. So we're down about 6%, which really isn't that bad. And I think that we can, between now and the end of the year, we can get those numbers back up there. There's my friend, Miss Cookie. Hi, Miss Cookie. So glad. It is a great morning. It's a great morning. So let me, I'm going to hide you for a minute so I can go down here to the stats. So here's the proof of the pudding, what I'm saying. If you look at 2020 month to date, we've done 911 homes. If you look at 2019 month to date, we had done 1,767 homes. So we were down about 856. And so that's this month. That's what's causing the issue. And like Jimmy brought out this week, it's because the pandemic started in the middle of March. So we did have cancellations, you know that. We had people that were not going out and looking at the homes, and we couldn't do live open houses. So, you know, those are the reasons for the stats. As long as we know, that's good. And the really great news is, everybody, we're maintaining our price point. You know, we're doing like an average of 335. Good morning, Larissa. It's so good to see you. And there's Charla. Hi, Charla. Thank you for joining me. And hopefully we can get Samir on here. Let's hide this for a second. And my guest, if she can get on, I don't know why she can't, is Samir Lopez, and she's a loan officer and with Fairway Mortgage. And she's calling me. Let's see what she has to say. It's not working. Okay, I'm going to call her. Let's call Samir and see why she can't get on. No, she's not answering. She's probably really freaked out. Hi, Samir. How are you? What's happening? Well, her phone didn't even work. Well, I don't know. Sometimes we have issues. Anyway, we're going to talk about mortgages today, and I'm going to put up some questions that if anybody out there wants to chime in and tell me, will any debt hurt my credit? This is something that we hear from our clients all the time. She's not answering again. Well, Samir, I miss you. Sorry you can't get on. All righty. Well, she's not answering. She's probably I don't know. So anyway, this is something that it's like a little credit quiz, and so if you're with a client, it's good to go over some of these things because they have these questions, and sometimes they make the relationship with you, but they don't have a lender. So, will any debt hurt my credit? Well, no, that's false, because an outstanding mortgage being paid on time isn't the same as $30,000 worth of credit card debt. So an outstanding mortgage that's paid on time is considered good debt, right? And I don't think agents are, newer agents and their clients don't realize that. And it can raise your score, but you need to stay away from the consumer debt, which is, don't go buy a boat, after you put an offer in on a house, right? Or a car, or, something that's going to put debt on and affect your credit score, because that's what happens sometimes. So we have to manage the expectations of our buyers. And then my second question here that I was going to have Samir help us with is, when I pay off my debt, it will disappear from my credit report. Well, that's false also, because as we know, paid debt will remain on your credit report for several years. It was paid on time. It can boost your score. Bankruptcy, defaulted loans, and other negative information can hurt sticking around for 7 to 10 years. So the question is, when I pay off my debt, it will disappear from my credit report. And the answer is, it depends. It depends on what kind of debt it was. So it can remain on your credit report for several years. If it was paid on time, it can boost your score. But bankruptcy, defaulted loans, and other negative information can hurt sticking around for 7 to 10 years. And then, a lot of things depend on other factors too. So here's another question that we get. Even though I got a promotion, my credit score is unaffected. Well, that's true, because income and job title may indirectly affect your score, but salary is not factored into your report. And I think a lot of people don't realize that how much money they make is not a product that they use or an element that they use to determine your credit score. So still, here's the heads up. Lenders may ask about your employment to determine how likely you are to pay your debts, because they use that loan to value and your debt ratio. So your debt ratio is directly related to your income. So that is another thing that we have to be concerned about. And Samir, if you're out there, if you can hear me, call me and we can put you on. We can still talk to you, even if oh my gosh, she's coming. Oh my gosh. There you are, Samir. Hi, Samir. I'm winging it. I'm sorry.
Oh, I think you're amazing. I wouldn't call that winging it, but it worked.
Oh, I'm
Good
so happy you're
morning.
here.
Yes, me too.
So we have an echo. So you may. Do you have your earphones on?
Let's see. I do not have my earphones on, but here. Does that sound better?
No, it's I can hear an echo.
Okay. Let's see here. Okay, let's see here. Still echoing?
No, I don't know what you did,
Okay.
but yeah. No, there it is again. Is your phone on?
No, yeah, actually, let's turn that off.
I don't know where this extra sound's coming from.
Let's see. Okay. Is that better?
Yeah. Okay, so well, now I hear the echo again. I don't know where it's coming from. And you don't have headphones? Earbuds?
Yeah. Let's see if I can get my headphones. 1 second, please.
Okay, and I'll go on. I'll ask some more questions. Now I'm echoing. Oh dear. So there it went away. No, it didn't. Well, I don't know what she did, but let's see if we can fix her. I'm gonna hide her. So now how's that? That's better. That's interesting. Okay, so all right, so I'm going to ask another question while Samir gets set up. So another question is, my spouse and I can run a joint credit report. Well, that's not true either, because each individual receives their own credit score. So your joint accounts and shared loans may impact each of your scores, since they'll appear on each of your reports. So that's why sometimes, a husband may take the home in his name because the wife had negative credit. So, that is the good news about that. Can we hear you, dear?
Yeah, I can hear you.
Okay.
Can you hear
me? I can hear you. Okay.
So would you like me to talk about that question as well?
Yes, please help.
Okay, great. So certain loan programs like VA and FHA will require 2 credit pulls, one from the spouse and one from the person buying the property, whether or not you're both on the application. Joint credit reports are used for that purpose. But there are some type of properties and some type of loan programs that only require one person's credit, and that's a conventional loan. That's where you do not include the spouse's debt. But if you're doing VA or FHA, certain debts of your spouse do apply. So it would be required about that.
So that's interesting.
Yeah. A lot of programs are tailored to community property statements. So what belongs to the spouse that they take out in debt would belong to the person borrowing. So that's where the joint credit report comes in. A lot of people use a conventional loan to avoid that specific rule and just have one person on credit when they apply.
Yeah. So if you're a government loan, both people have to apply.
Both credits have to be pooled. Yeah. So let's say Bob and Laura were buying a house. Laura has 2 vehicles because she bought one for her sister and herself, and Bob does not have a vehicle. Bob wants to go buy a home VA. Both credits get pulled. Both cars count against Bob. So That's how that works. Yeah. So that's kind of interesting. So it's always good to get with a lender to find out specifically what the goals are, to see, do we pull both credits? Do we not pull both credits? But I heard what you had said, and there is a lot of truth to that. Like, you don't have to do it, but some loans require it. Yeah.
Well,
So.
that's good to clarify and correct what I said. So
No, oh, I'm so sorry. I just wanted to make sure.
no,
I'm
because
so excited to be on.
yeah, I'm going off this credit quiz, you know, and it's obviously outdated. So that's good to know. Yeah.
Yeah, for sure. I'm super excited. What else did we talk about, or what else should we talk about? Because I got a lot of stuff to talk about.
I want to talk about forbearance and what your clients are doing right now with their loans. And I don't know if you heard me say that we're down about 700 and some sales this month because of what happened in March and April. So now it's hitting us with closings. So, but I see that it's going to go back up. Are you still doing loans for people that want to buy homes?
Yeah, so I work at Fairway Independent Mortgage Corporation, and we're one of the largest FHA lenders, VA lenders, conventional lenders. And this last month in April, 80% of our local business here where I work at was purchase business. So we do see a lot of activity still. And I think that that's from how low interest rates are. So you have an industry that's used to $2 trillion in mortgages per year. And we have about 11 trillion going around nationwide, right? So it's like trying to put a gallon of water in a straw. So it is very, very busy. I think what has happened, though, where you see in real estate where it may have slowed down is because of capacity issues. Things can take longer. And also because of, COVID-19, right? A lot of people have the option for a forbearance. And what a forbearance is, it's a temporary forgiveness of payment to pay at a later time. So a lot of people who have lost their jobs or their family dynamic has changed in the household income-wise have opted to pause their payments for a short amount of time in order to, weigh the COVID-19 out. So when you have that option, that can slow down a market. I can see how that can happen, right? Or you can, I could really take advantage of not paying a mortgage right now because of a hardship,
Right. Yeah.
So,
and so, Samir,
what happens there, what we have seen is when, this is interesting, this affects like people in the audience, if you have a lot of realtors or just consumers, when you see people opting for the forbearance, it's not free, it gets paid at a later time. But what happens is the servicer is losing out money. So when someone does not make their mortgage payment, someone has to, and that's usually the servicer, the entity that is on your bill, your mortgage bill. So they have to front that money. And these servicers are excited. You know why? Because right now rates are at like the mid twos, high twos, and they have now locked in that consumer to their 4 or 5%, because guess what you can't do within a year typically is resell your home or refinance your home. So now they got you at a higher interest rate for much longer. So that does affect, some realtors in, that now, Susan and Paul will not sell their house for a year because they have maybe a prepayment penalty because of the forbearance. Though it helps Susan and Paul. Now they're kind of stuck a little bit, right? So that's going to be a little bit more challenging. But what also happens when people go on forbearance is because the servicer is losing funds, guidelines get tighter when you buy a home. So where you would walk into a typical lender and say, I would like an FHA loan, my middle score is 580. Well, today the middle score is 610. Last week where I worked at, it was 640. So, it fluctuates because of the forbearances. So it's like a domino effect because it's never really free. There's always like a risk involved. So when the servicer starts dishing out payment, when a person cannot pay, the money they lend is a little tighter. So they also, change the guideline. So that's pretty interesting. So if you've seen something slowing down, I think people are like pausing and watching. But for the people who are watching this episode, and especially you, Ruth, because you're a realtor, there's still business out there because rates are low and there's still essential work out there. There's a lot of veterans, there's people on a fixed income, people that are self-employed that are still working, that there is business to be done. But I'm not surprised if you've seen it slow down. Just people, they have to get educated. I mean, these interest rates are very low. I haven't seen them this low in the past. At least since 2009, 10 is when I saw the rates this low again. So I don't know. I hope that helps answer your question or what we're talking about, because forbearances are good, but it causes like a ripple effect with lending, especially.
So what you said is that if I have a forbearance loan, can I sell my house?
You can sell your house, but there may be prepayment penalties involved. Or can you refinance your house within that year? It can cause you to be put in a position of time where a refinance or selling your home might be more expensive than it would have been not doing a forbearance.
So if I sell my home and I've done a forbearance, that money gets added to the loan that I have to pay back.
Yeah, because it's not free. It won't be free, right? So forbearance is not where you just will not have to be obligated for the money that you're not paying that month. It goes into the loan. Another thing is, depending on different servicer rules, there can be prepayment penalties now because you activated a forbearance.
There can be prepayment, okay.
Yeah, penalties.
So, and that's how the servicer gets their money that they lost? Is that what you were saying?
They actually gain more money. They lose in the short term, but gain in the long term.
I see.
So when you lose, yeah, does that make sense?
Yes.
Because they're dishing out, when you think about, a $360,000 home times, it could be somewhere up to 11 million a month, 30 million a month that they're making in payments alone, because 30% of people are not necessarily paying their houses if they're unemployed. So the servicer has to dish out the money, still pay Fannie, Freddie, Jenny, and that tightens up their liquidation, changes guidelines on one side to get a loan, and then the consumer that is in that forbearance is now stuck for not being able to refinance in the next year. So they're at a higher rate when they can be opting for lower rates. And if they sell too early, there could be a possible prepayment penalty, which is, a percentage or a charge that they would be paying versus paying before. So, yeah. So it's pretty interesting. We get a lot of these questions, back in 2008, where forbearances were all across the board. You couldn't get modifications done as quick as possible or a forbearance. And now the market is somewhat stable because these forbearances are in place for what? So people will not foreclose or default. So that to me keeps the market stable. I get a lot of questions about that. So have we slowed down? Absolutely, we slowed down. The whole globe has slowed down. But as far as the market goes, I think these are safety measures that are put in place so people do not lose their homes, which would affect the market. So every time I get asked, I say, I think it's stabilizing and there are safety measures in place so we don't see a 2008, right? We can't control what's going on per se, but we have learned from the past, even though forbearances may tighten up guidelines, right, for lending, meaning you in and the 580 FICO score is now 620 because it's a bank overlay, but we're keeping the market in place. It's being responsible so that the market stays consistent. But there is a lot of business still happening. Just want to let you know that. Just what changes, you got to go with the tide. And for the people like you or the people watching your show, those are people that want to get educated they should be out there getting business, because there is business to be done with these low interest rates. That makes sense.
So here's an example. So I had a client who went into forbearance, even though they could afford to pay. They felt, not knowing what the market was going to bring, they would wait and take that 3 months or 4 months, whatever it was, and then pay it back.
It's there, you know, we can't really change the fact that it's not available, because it's available, so that we don't have another 2008. Did it work to their favor? It might have been an insurance policy for them that might cost them a little bit more. So,
but when they pay it back, do they still have that prepayment penalty that may be assessed?
It may be assessed, and every servicer is different, just so you know. But, you know, when you think about it, is there ever a free lunch? I know that sounds kind of like a saying, but I don't know that there's ever a free lunch. You know, but it's what's in place for now, right? It's what's in place for now. It's not necessarily a bad thing, but if you don't really educate yourself when you talk to the servicer, when you need this help, and here's the thing, and I don't want to go too far off, but if you call in to your servicer just to ask about a forbearance, have you ever heard a scenario where all of the sudden you max out a credit card, you max out a MasterCard, then all of a sudden your Discover card and your Best Buy card, the balances went from $2,000 to $1,000. Fannie Mae's getting alerted now, and Freddie Mac. These are the investors tied to the mortgages when a consumer calls in. And it is now where the servicer has to inform Fannie Mae, Freddie Mac, Jenny, that a consumer has called, right? So they all go under the umbrella of TransUnion, Equifax, and Experian. So all of a sudden you call in to ask, or maybe your clients, their credit card limits have been cut in half because there's technically a hardship or strain on them financially. So what do these credit card companies not want? For your client to be overextended. So there's something called credit score. So how your credit score is generally measured is if you have a credit card and it's maxed out, or if it's above 50%, your credit score can lower. But when your credit card is at 10% availability, meaning your charge, let me give you an example. $1,000 credit card limit. If you have $100, that's the best measuring tool to increase your score. If you're maxed out, you don't have as many points, your score can go down. So as you're calling in for these forbearances, they're alerting all your creditors, you're not maxed out on your credit cards. You're at 50% of your credit cards, right? You've been responsible, 30% of your credit cards, but all of a sudden your credit cards have decreased the availability, and they have every right to do so. So now, because you were at 50%, you're now at 80%, where you compared to how they lowered your credit card balances. So these forbearances can hurt in other ways too. So now your client's credit score that was 740 that they were so proud of is now 660, just because the forbearance. So that's something to think about. You know, it's all relative. Like I said, it's a ripple effect of how all this happens. So there's never really a free lunch. But, you know, it's a safety measure. I mean, what are your alternatives if you do have a hardship? I mean, we as lenders and realtors work hand in hand. We want to make sure the market stays healthy, right? So, you know, there's just so much that you can look at the pros and cons. I think that forbearances are a pro, but I think it's for the people who absolutely need it, and the consumer or clients, if you hear about them asking for forbearances, hopefully they get educated before they just, go into it. That's for sure.
So Larissa says, just for calling, you get penalized.
Well, you can get reported if your number gets tracked and gets back to the bureaus. Yes. So
Wow.
It could possibly happen. It depends on your servicer. And I know that sounds crazy. I'm not saying all servicers, but it's very relative and it's very obvious. I don't know if any of your watchers have ever maxed out a card or been in the line and the credit card did not go through and you wondered why, because your balance was, the availability was higher, and it changes because, we're more advanced now. Everything reports, through different applications that we There's lobbyists up in Washington, and, and they work to, protect and not, have consumers get in a position during a hardship that is working backwards. It's not helpful for people. But yeah, it's kind of unfair at the same time. But, I think when this happened in the market, COVID, just people took action because it's such a big industry and it's such an important industry that there had to be some measures to help people and also to stabilize the market. But as a consumer, it could be, you can have a lot of different effects doing certain actions. So I would definitely consider, trying not to do a forbearance if you don't have to. That's what I would probably do. Yeah.
So Samir, your information is so valuable. Would you consider coming back next week with me and Jimmy?
I will. And
Jimmy won't be here next week, but you could come back with me and let's continue this because there's a lot of interest here, but we're at our 30-minute mark and we have to go.
Oh, okay, for sure. Ruth, it was fun and thank you so much.
Oh, I appreciate it. And whatever your glitch was, we'll figure that out too.
Yes, yes.
Maybe you can come by the office,
Yeah, that'd be great. That'd be so much easier.
So this week we're having our social media classes Tuesday, Wednesday, Thursday. And if you'd like to come and speak at one of those for lunchtime, would you like that?
Sure. Yeah, absolutely.
So that would be great. And we teach from 10 to 2, Tuesday, Wednesday, Thursday. It's pretty intense social media, but, we'd love to see you. We got to go because we're running out of time. But Samira, thank you so much. You have been so helpful. You've got lots of questions here from people. And let's get together next week again.
Okay. Thank you so much. Thank you.
Welcome. Bye, everybody. We love you.
Bye.